you need to know one thing, that what is option and what are the other types of derivatives you can have. So let's start with introduction of the derivatives. What is derivative? It is a contract which does not have its own value. Value of this contract is derived from the value of any other item, which is called the underlying. एक ऐसा कॉन्ट्रैक्ट जिसकी खुद की वैल्यू नहीं है, जिसकी वैल्यू दूसरी आइटम की वैल्यू से डिराइव होती है, और उसीलिए उसको हम क्या कहते हैं? डेरिवेटिव कहते हैं, राइट? A contract which does not have its, what is derivative? It's a contract. What type of contract it is? It's a contract which does not have its own value. Then how do you determine value of a derivative? The value is dependent on the value of any other item. That other item is named as the underlying. Since the value is derived from any other item, as the contract is named as derivative. As the contract is named as derivative. Let's take one example. Suppose current price of the gold per 10 grams is rupees 46,600. Let's assume. I know current price is on the higher side, but let's take this situation. As of today, gold is available in the market at the rate of rupees 46,600 per 10 grams. Now suppose I am bullish on gold price. Me, Tarun Mahajan, I am bullish on the gold price. I think that in the next 2-3 months, gold price will actually rise. Looking at the current COVID-19 situation in India and worldwide, again, people have started to lose faith in economies. People have started to lose faith in securities such as shares and debentures. And that's why there are chances that people will again show more faith in gold. And consequently, the gold price will actually rise. So I am bullish on gold. What do you say? Let's talk about you. But suppose you are bearish on gold. You say, no, sir, the gold price is already on the very higher side. And it is least expected that the gold price will rise further now. I am bullish that the gold price will rise. You are bearish that the gold price will actually fall. See, so we have a disagreement. If uncivilized people have a disagreement, they are indulged into the feast fight. But we are educated people, we are civilized people. So this disagreement may at the most result in a bet. Let's bet on the gold price. I am saying that the price will rise. So at the current price, I must be ready to buy. You are saying that the price will eventually fall. So you must be ready to sell at the current price. Because in future price will fall. So currently you can sell at a higher price. The one who is bullish is ready to buy. One who is bearish is ready to sell. So let's enter into a contract that after 3 months, I will buy 10 grams of gold from you at a price of rupees 47,000. So we entered into a contract that after 3 months, I will buy, you will sell 10 grams of gold at a rate of rupees 47,000. Now this contract is actually named as a forward contract. See, if I buy 10 grams of gold from you today at 46,600, I pay you cash, you give me delivery. We enter into a contract today. I give you cash today, you deliver gold to me today. It's a spot contract. But we enter into a contract today, which will be executed on a specified future date. We enter into a contract today, which will be executed on a specified future date. That is after 3 months, you will deliver 10 grams of gold to me and I'll pay 47,000 rupees cash to you. This is called a forward contract. And forward contract is basically an example of derivative. There are four basic types of derivatives: forward, future, option, and swap. This is an example of forward contract. 46,600 is the spot price and 47,000 is the forward price. So usually forward price remains slightly marginally higher than the spot price due to the effect of the interest. So spot price plus risk-free rate of interest gives you an ideal forward price. Okay, but I'm bullish, you're bearish. I say, okay, fine. I'll buy 10 grams of gold from you after 3 months. Now, this contract is a derivative contract because it does not have its own independent value. Rather than value of this contract is dependent on the value of the gold. So after 3 months, if the gold appears at 43,000 rupees, still I will have to take delivery of gold from you at 47,000 rupees because I am committed. I'll take delivery of gold at 47,000 rupees. I don't want to keep it. So immediately I'll sell it out in the market at 43,000 rupees and I will sustain a loss of 4,000 rupees. See, at the same time, you were not having a ready gold delivery. So you bought it immediately from the market at 43,000 and delivered to me under the contract at 47,000 and you made a profit of 4,000 rupees. So alternatively, what we can do is, see, what we are doing currently is you buy it from the market, you deliver it to me, I sell it into the market. You buy it from the market at 43,000, deliver it to me at 47,000, make a profit of 4,000. I sell it out in the market at 43,000, make a loss of, sustain a loss of 4,000. Now that's the beauty of a derivative contract, that I don't have money to buy the gold, you don't have gold to be delivered, and still we entered into a contract because the contract was to be executed after 3 months, and that's why we could enter into a contract. In fact, rather than doing the delivery settlement, any derivative contract may be settled in the market either by delivery or by cash. Let's do one thing. Let's not do delivery settlement. Let's simply do the cash settlement. I agree that I sustained a loss of 4,000 and you made a profit of 4,000. So forget about gold delivery and everything. I will simply give you 4,000 rupees and this is how the contract will be settled. Any derivative contract may be settled in one of the two manners, either by delivery or by price difference. So anyways, value of this contract after 4 months, after 3 months, that is at expiry of the forward contract, is 4,000 rupees. Value of the contract is 4,000 and this value is dependent. This value is derived from the value of the underlying, that is gold. As the value is derived, hence the contract is named as derivative contract. So I have already explained you about delivery settlement and cash settlement. Now let me tell you some more terminologies quickly. What is long position? In the derivatives market, a buying position is called the long position. Like in this example, I agreed to buy. In this example, I agreed to buy. So in the forward contract, my position is named as the long position. Usually long position is taken by a person who is bullish on the price. Because when you take a long position and price rises, you make a profit. In this example, after 3 months, if the gold price appears to be, say, 50,000 rupees, in this example, after 3 months, if the gold price appears to be 50,000 rupees, then I'll win the situation because I have the right to buy at 47,000 and the price is 50,000. So I'll recover 3,000 rupees from you. On the other hand, if price falls, like it becomes 43,000, in that case, I will sustain a loss because I have the duty to buy. I have the right to buy at 47,000 and I have the duty to buy at 47,000. So I have the duty to buy at 47,000. Even if the price falls down to 40,000, still I will have to buy at 47,000. So I sustain a loss. So one who is bullish is ready to buy position is called long position. We don't call it buy because I'm not currently buying. I agreed to buy after 3 months. And that is called the long position. One who is bearish, he will be ready to sell. So he'll enter into a contract to sell in future. Short, this is called short position or selling position. The short position makes a loss if the price rises. So you agreed to sell at 47,000. If price rises to 50,000, still you will have to sell at 47,000. So you'll make a loss of 3,000. You agreed to sell at 47,000. Price falls down to 40,000. Still you have the right to sell at 40,000 rupees, 47,000 rupees. So you'll make a profit. Just keep in mind one thing, that I have a long position. You have a short position. I have right to buy as well as duty to buy at 47,000. You have right to sell as well as duty to sell at 47,000. See, in any contract, both parties have right and both parties have duty. So if I'm buying, I have right to buy and duty to buy. If you're selling, you have a right to buy and duty to sell. I'm sorry, you have the right to sell and duty to sell. If price rises, I will say I have right to buy. If price falls, I'll say I have a duty to sell, a duty to buy, I'm sorry. If price rises, you have the duty to sell at the contracted price. Even if price falls, you have the right to sell. Both parties have right as well as duty. So this was a quick example of derivative. But if I talk about derivatives, I told you that there are 4 types of derivative contracts: forwards, futures, options, and swap. The last example we took, where 2 of us dealt with each other, was the example of a forward contract. Last example was the example of a forward contract. Okay, I request all of you to please turn on your cameras, because that's the requirement of IBPI, and maybe your attendance may not be marked if you keep it off. In fact, I'm taking sessions with various RVOs, and I have faced this 2 times, that suddenly IBBI people came for inspection. I won't name RVOs, but yes, in my sessions it happened 2 times. But all of a sudden they appear and then just they take the screenshot, etc., and then they go away. Okay, so you have forward contract, future contract, option contract, and swap contract. These are the 4 types of contracts: forwards, futures, options, and swaps. So the example we were talking about, 2 of us dealing with each other personally, was the example of forward contract. If there is any doubt, just feel free to ask it to me. So let's define forward contract. What is forward contract? Forward is nothing but you're fixing your future today. You can enter into a forward contract with IBBI that they will declare you a valuer in your first attempt of examination. They don't do such type of contracts. But forward means you decide something today कि दुनिया का चाहे जो भी हो, but मेरा वही होगा जो मैंने आज decide कर लिया. So what is forward contract? It is fixing of future. Okay. Fixing the future today. Fixing the future today. Both parties have right as well as duty to execute the contract. Like in our example, it was a forward contract where underlying was gold. You know, in a forward contract, you fix everything. What do you fix? First of all, you fix the underlying. In our example, underlying was gold. But one can also choose silver to be the underlying. One can also fix the underlying to be platinum, or it may be aluminum, or it may be copper, or it may be anything else. It may be some agri commodity. It may be soybean, wheat, pulses. It may be orange juice. It may be meat. It may be share price of a company. It may be Sensex or Nifty value. it may be interest rate, it may be the amount of rainfall, it may be the temperature which will be touched, highest temperature which will be touched in the month of May in Delhi. Anything and everything in this world. It may be the score of, now the IPL is gone, but otherwise it may be the score of a team in the next match. Anything and everything in this world which is uncertain and which is uncontrollable can become underlying. Uncertain and uncontrollable. See, we two enter into a gold price. Gold price is uncertain and none of us can control it. But suppose two big people, two wealthy people enter into a contract that this batsman will score not more than 30 runs in the coming match. Now that's illegal because though it is uncertain, but it is not uncontrollable. If the bet is of a huge size, you can go to the cricketer, batsman and say, look, you need to get out before 30 runs because my 500 crores rupees are at stake. My 5 crore rupees are at stake. My 50 crore rupees are at stake. I'll give you 5 crore. So you need to get out at 29 runs. So uncertain and uncontrollable things can become underlying. Then what do you fix in a forward contract? You fix the quality. Like in case of gold, we need to decide, is it a 22 karat gold or 24 karat gold? Here the purity is 99.95. Suppose it may be 99.99 also. See, the quality is decided only for commodities. If it is a currency or if it is a equity, then you don't decide quality. Let's enter into a dollar purchase contract. So what quality of dollar will you give me? There is only one quality of dollar. You don't have different qualities of dollars available in the market. Then you fix quantity. Like in our example, it was 10 grams. Then you fix the maturity date. In our example, it was 3 months. Then the most important thing you fix is the rate. That whatever is the rate in the market, we will deal at 47,000 rupees. So what is forward? Nothing but fixing of underlying quality, quantity, date, and rate. So the question is, what are future contracts? Very simple. Rather than dealing with each other personally, see, I was bullish on gold and I was trying to search a party who is bearish on gold. So in my network, I couldn't find any party. I'll go to National Stock Exchange. I'll go to multi-commodity exchange, better I say. I'll go to MCX, I'll go to NCDEX, I'll go to Chicago Board of Trade America and search over there that is there any party I'm ready to buy after 3 months? Is there any party who is ready to sell? And at MCX, I found a counterparty and we dealt with each other. Now, this is no more a forward contract, it's a future contract. What is future contract? It is exchange traded forward contract. If we deal with each other personally, over the counter, across the table, it is forward. But if we deal through any exchange, NSE, BSE, MCX, NCDEX, or any other exchange, then we don't know each other personally. Every single person here must have experienced share trading at least once in their life. You know it very well that when you deal at a stock exchange, you don't know who is your counterparty. Okay, tell me, do you know the name of your counterparty, his age, her age, gender, caste, creed, religion? Do you know it? Do you know details of your counterparty when you buy or sell the stock? You buy 10 shares of Reliance Industries Limited today. Will you ever be able to know who is your counterparty? No, you don't. Because you have exchange in between. And basically, you are not buying from the exchange. You are not buying from the counterparty. You are, though you and your counterparty is dealing with each other, but we assume that I am buying it from the exchange and you are selling it to the exchange because we don't know each other. This is called a future contract. So your counterparty is NSE, my counterparty is also National Stock Exchange. But in this case, what happens? In a forward contract, forward contract in Hindi, it is called वायदा सौदा. तो आप और मैं दोनों मिलके वादा करते हैं. फिर चाहे हम उस वादे को निभाएं या ना निभाएं, और हम एक दूसरे की जुबान पर भरोसा कर लेते हैं. बट इन केस ऑफ ए फ्यूचर कॉन्ट्रैक्ट, एनएसी वोंट एक्सेप्ट दैट टेनी आप पे भरोसा है. अरे Mr. Tarun, you are a very reliable person. We believe you. No, never. NSA will say, whosoever you are, Tarun, you need to give a security deposit in case you fail to fulfill your commitment. We will use your security deposit. Both parties need to give some deposit. They don't call it deposit, they call it margin. It may be initial margin, it may be mark to market margin, it may be variation margin, it may be maintenance margin, it may be basket margin. Various types of deposits are there. So in case of forward, you don't give any security deposit, but in case of future, you need to give. One more thing which makes a forward different from the future, you know, there's one beauty also. In case of forward contract, your counterparty may default, so you have the counterparty risk. But in case of futures, your counterparty will never make a default because it is a big stock exchange, and on the top of it, it is taking deposit from both parties. So in forward, you have the risk. In future, you don't have the execution risk or counterparty risk. Now, forwards may be customized. Instead of 3 months, I can say, let's have 3 months, 8 days. Instead of 10 grams, we can enter into a contract to buy 11.664 grams, that is 1 tola. Instead of 99.5 purity, we can enter into 18 karat gold contract. So whether it is underlying quality, quantity, date, we can customize it as per our wishes. But in case of a future contract, they are standardized. So exchange says only 1 month expiry, 2 months expiry, and 3 months expiry are available. That is, this is May. So only May end, June end, July end contracts are available. So that's it. Only gold is available, silver is not available. That's it. Only 1 kilogram multiple may be dealt. That's it. Only 99.5 purity may be dealt. That's it. They can standardize it. So on one hand, it looks like restriction, but on the other hand, the standardization gives you liquidity. See, customized things are difficult to sell out. Suppose you buy a second-hand bike and get it modified. You know, height of the shock ups, nitrogen tank, so much other type of bike, you get it customized. It's difficult to sell it out later. But if it's a standard two-wheeler, Honda Activa kind of thing, it's easy to sell it out later. So standardized contracts are liquid because thousands and lakhs of parties are available to deal in that contract. In future, you get rid of counterparty risk. In future, you get liquidity, which is not available in forward. Now, with this background, let's try to understand what are options. Okay, let's take one example. Let's continue the previous example. I'm bullish on gold and I'm ready to buy at 47,000 rupees after 3 months. And you are bearish on gold. You are ready to sell at 47,000 rupees after 3 months. We enter into a contract where I say, listen carefully now, where I say that after 3 months, if this contract becomes favorable for me, that is the market price rises above 47,000, then I will execute this contract and recover difference amount from you. But if the gold price comes down, then why should I buy gold from you at 47,000? In market, it is available for 42,000. So better I'll buy it from the market, not from you. It means if the price becomes unfavorable for me, then I will not pay you the difference as a loss. Rather than we will simply forget about the contract. So I have the option. I have the choice to execute or not to execute the contract. And you have the duty to honor my choice. I have the choice, I have the option. Option 1 to execute. Option 2 to forget about it, not to execute. Option 1 to execute, obviously if the price goes up, I'll recover difference amount, execute the contract. If the price comes down, I'll say forget about the contract, why should I pay you the difference? But you will think that this is beneficial only for Tarun Mahajan. This is not beneficial for you. Why should you enter into such a contract with me at all? I'll tell you. Let's first learn one thing, that options are similar to futures. Somebody asks you what is option, you'll say it's similar to future. But there is one major difference. In future and forward, both parties have right as well as duty. Here one party possesses only the right, while other party has only the duty. I have the right to buy. If I exercise my right, you have the duty to sell gold after 3 months at 47,000 rupees. Right? If price goes up to 51,000, I'll exercise the contract and gain 4,000 rupees. If price comes down to 45,000, I won't pay you 2,000 rupees. I'll not execute the contract. Now, in this contract, I am holder of option. I hold the option. You are writer of the option. I am holder of the option. You are writer of the option. I am holder of the option because I am holding the option. And you are writer of the option. You know, here my position is called long position. See, it's not long because I'll buy gold. No, not at all. It's long position because I have bought option. Yes, I have bought option. Actually, I'll pay premium to you today. See, I'll buy gold. That's something that will happen in future. But today I'm buying an option. You know, you buy insurance policy for your car. So you pay premium. And insurance company receives that premium. If the market price of the car rises, you need not to pay to the insurance company. But due to accident, if the car's price reduces, an insurance company will compensate you the difference. What happens in case of insurance? Either they compensate you your losses or nothing happens. So they just have the duty to compensate your loss. And you just have the right to get compensated. So to do that, you need to pay premium. Similarly, here I'll give you premium today. And just like insurance premium, this premium is non-refundable in any case. Whether I exercise my option or I don't exercise my option at expiry, this premium is non-refundable. See, in this contract, my maximum loss is limited up to the amount of premium. Even if the gold price falls down drastically, say to just 30,000 rupees, I won't suffer a loss because I won't execute the contract. But if the gold price rises from 47,000 to 48,000, I'll make profit of 1,000. From 47,000 to 57,000, I'll make profit of 10,000. From 47,000 to 1,47,000, I'll make profit of 1 lakh rupees. So my maximum profit is unlimited and my maximum loss is limited up to the amount of premium. Now, being the option writer, your maximum profit is premium. You cannot gain more than premium. And your maximum loss is unlimited. My maximum loss is premium. Your maximum profit is premium. My maximum profit is unlimited. Your maximum loss is unlimited. See, I have right to buy gold. Even if I have right to sell gold, still I am the option holder. Even if I have the right to sell gold, that if price becomes favorable, I'll sell it. Otherwise, I won't sell it. Still, I am the option holder. Still, my position is long. Say, I may be long or short on the underlying, but I'm surely long on option. I may be long on underlying, I may be short on underlying, but I'm surely long on option. And you're surely short on option. One who is long on the option pays premium initially. One who is short on the option receives premium initially. So the long option position offers maximum loss up to premium and unlimited profit. Short option position offers maximum loss unlimited and profit limited up to premium. You might be thinking that in this case, practically nobody would like to become the writer. Everybody would like to become the holder. No, not like that. In fact, institutional investors, I mean to say, bade khiladi, they prefer to become writer only. They don't prefer to become holder. क्योंकि कहने को मैंने कहा कि लॉस अनलिमिटेड है, बट आप खुद सोचो कि 10 ग्राम गोल्ड पर 3 महीने में अनलिमिटेड लॉस तो नहीं हो सकता. 47,000 का गोल्ड 1 करोड़ रुपए का तो नहीं हो जाएगा. क्या फ्लक्चुएशन होगा? 47,000 will become 57,000. वर्स्ट केस सिनारियो. कहने को अनलिमिटेड लॉस है, बट प्रैक्टिकली लिमिट है. प्रैक्टिकली 99% केसेस में लिमिट है. अगर आप काफी बदकिस्मत हुए तो बात है. Now options are of two types. One is called the call option, and the other one is put option. If I say I'll buy gold after 3 months, this is call option. If I say I have a choice to sell gold to you after 3 months, this is called put option. Right to buy is call option. Right to sell is put option. If I have the right to buy, my counterparty has the duty to sell. This call option is exercised only if the market price goes up above the exercise price, strike price. So I have right to buy at 47,000 rupees. If the market price goes up above 47,000 rupees, I'll exercise my option. Now, the beautiful thing is that I can choose the strike price also. मैं ये तो कह ही सकता हूँ कि okay, I want to buy gold after 3 months at 47,000. But we can also enter into a contract where I say I want to buy gold after 3 months at 37,000. Even if gold is currently available at 46,600, I can choose the strike price also. But if I choose a very favorable strike price, I'll have to pay a very high premium. If I choose reasonable strike price, I'll have to pay reasonable premium. If I choose unfavorable strike price, that okay, I'll buy gold from you at 55,000, then my premium will be very, very lower. So call option is exercised only if market price rises beyond, above the strike price. In fact, I can calculate suppose for this gold contract at 47,000 rupees per 10 gram, suppose I have to pay you a premium of 1,000 rupees per 10 gram. To enter into this contract, I am required to pay 1,000 rupees premium to you. Let's assume. So you know what happens? In a call option, I gain profit if the market price is above strike price. If market price is 47,001 rupee, I'll recover 1 rupee from you on exercise of option. If it is 47,500 rupees, I'll recover 500 rupees from you. If it is 48,000 rupees, I'll recover 1,000 rupees from you. If it is 50,000, I'll recover 3,000 rupees from you. But in any of these cases, I have already paid you 1,000 rupees premium. So if the price is 47,800, though I'll recover 800 rupees from you, but at the same time, I have already paid premium of 1,000. So sustain a loss of 200. My break-even point will be when the market price becomes equal to strike price plus premium. Strike price is 47,000. Premium I have paid to you is 1,000. So 47,000 plus 1,000 is 48,000 is the BEP. If the market price reaches this level, then I'll be able to recover my premium. And beyond this, I'll start making profit. Below this, I'll have a loss. But my loss is limited to 1,000. Now put option. In a put option, I have the right to sell. If I have right to sell, then you have duty to buy. It is exercised if the market price comes down below the strike price. So I choose to sell it 47,000 rupees. If the market price appears to be 45,000 rupees, I'll exercise my option and I'll tell you that, okay, come on. Though the market price is 45,000, still I have the right to sell it 47,000 rupees. So if the price comes down, I'll exercise the option and recover difference from you. If the price goes up to 48,000, I won't pay you difference amount as loss. In forward and future, I would have paid you difference amount as loss. But in option, I will not exercise this option. So put option is exercised below the strike price. Here my break-even point will be equal to strike price minus premium. The break-even point will be equal to strike price minus the premium. So let's sum up this entire thing. In case of a call option, there are two parties. One is holder and other one is writer. Instead of calling him a holder, you can call him long call. Instead of calling it a writer, you can call it short call. So if I'm long call, my counterparty, you are short call. One who is call holder has the right to buy. One who is call writer has the duty to sell. Call option will be exercised if the price is above strike price. In case of put option, holder has right to sell. In case of put option, writer has duty to buy. Put option will be exercised by a holder below the strike price. Keep in mind, an option, whether it is call or it is put, is always exercised by the holder. Writer never exercises option. He has just the duty. You will find 1 mark MCQ definitely based on this table. So holder pays premium and writer receives premium. Whether you are call holder or you are put holder, in any case, if you are holder, you pay premium. If you are call or put writer, you receive premium. Whether you are call holder or put holder, your loss is limited to premium and profit is unlimited. And whether you are call holder, whether you are call writer or put writer, your profit is limited to premium and loss is unlimited. Okay. So let's take one example.
Hello.
Suppose
Hello, sir.
Share price of Reliance Industries Limited today is 1,200 rupees. and you choose the strike price to be 1,000 rupees. So what do you say? That though share is quoted at, let me tell you one thing, that the share price is just one price, but strike price you can choose from the strike price spectrum available at the exchange. You can see, I'll tell you one thing. Look, listen carefully. In case of spot contract, there can be only one type of contract. That is, I am buying RIL share, you're selling RIL share. Make a phone call to broker. Hello, what is the price of RIL? He'll simply reply 1,200 rupees, full stop. But make a phone call to broker and ask him, what is RIL future price? And he will ask you a question that there are three types of RIL future which are available. This month, next month, and next to next month. So a single underlying becomes three types of contract. You know, at NSE, usually they make available 1 month, 2 month, 3 month contract. That's why a single future contract, single underlying becomes three types of contract. So he will ask you, so sir, are you asking RIL May future or June future or July future? So one underlying becomes three products. In case of option, number one underlying will become three products, 1 month, 2 month, 3 month. Okay, forget about it. You ask, can you tell me RIL option premium for month of May? He will still ask you, you know, one RIL will become 6 contract. 1 month call option, 2 months call option, 3 months call option, 1 month put option, 2 months put option, 3 months put option. One single RIL will become 6 products. वो भी तब जब मैं मान रहा हूं कि only 3 expiries are available. Practically 20 expiries are available. So 20 call options and 20 put options. Okay, let's take 3 expiries only. So 1 month call, 2 months call, 3 months call, 1 month put, 2 months put, 3 months put. Already these are 6 products. इनमें से किसी में भी आप डील कर सकते हैं. तो अभी आप ब्रोकर को फोन लगाते हैं, भाई साहब रिलायंस इंडस्ट्रीज लिमिटेड कॉल ऑप्शन 1 मंथ का प्रीमियम बता दीजिए. बोलेगा सर इसमें भी 10 तरह के प्रोडक्ट अवेलेबल है. स्ट्राइक प्राइस 1000, क्या करना चाहते हैं आप? 1 महीने बाद RIL 1000 रुपए में लेना चाहते हैं तो वो भी एक कॉन्ट्रैक्ट अवेलेबल है, और 1400 रुपए में लेना चाहते हैं तो वो भी एक कॉन्ट्रैक्ट अवेलेबल है. आप बोलो आपको क्या भाव खरीदना है. आप सोचोगे फिर जब ये 1000 में अवेलेबल है तो मैं 1200 में भी क्यों लूं? See, if you choose a favorable strike price, you will have to pay very high premium. And if you choose unfavorable strike price, you'll have to pay very low premium. If you choose a reasonable strike price like this, then moderate premium will have to be paid. Yes, Lokesh ji, please feel free to ask. You have posted that you want to ask one question.
सर मैं ये कह रहा था कि
Unmute yourself, I can't hear.
होल्डर ने अभी जो आपने एक टेबल ऊपर बताया था कि होल्डर राइट टू बाय है, लेकिन वो एक्सरसाइज तब करेगा जब स्ट्राइक प्राइस से अबव होगा.
Exactly.
लेकिन सर मैं तो कोई भी चीज तब खरीदूंगा जब वो प्राइस से कम होगा. मतलब या तो मेरे को लोअर प्राइस पे मिल रहा होगा तब मैं उसको राइट करूँ, मतलब उस राइट को एक्सरसाइज करूंगा.
Now I got your point. See, क्या है कि मैंने आपसे कॉन्ट्रैक्ट करा कि मैं आपसे 47,000 रुपीज में गोल्ड खरीदूंगा आफ्टर 3 months. ठीक है, अब 3 महीने निकल गए, मुझे गोल्ड की वाकई जरूरत थी. 3 महीने निकल गए, 3 महीने बाद मार्केट में प्राइस 49,000 रुपीज. तो अब या तो मैं मार्केट से खरीद लूं या मैं अपना राइट एक्सरसाइज करके आपसे 47,000 में खरीद लूं. राइट, समझ गए? और प्रैक्टिकली तो मैं डिलीवरी सेटलमेंट करूंगा भी नहीं, मैं बोलूंगा लुक मार्केट में 49,000 है, आपको तो 47 में देना पड़ेगा, चलो लाओ 2,000 रुपए डिफरेंस निकालो, बात खत्म। सो नाउ द ब्यूटीफुल थिंग इज कि ये एक सिंगल आरआईएल का जो शेयर है ना, वो 3 कॉल 3 पुट, और फिर हर एक कॉल पुट में 10-10 तरह की स्ट्राइक प्राइस मान लो, तो मतलब 6 into 10 600 तरह के कॉन्ट्रैक्ट सिर्फ एक शेयर में आप कर सकते हैं। आरआईएल का कैश मार्केट डील करने जाओ तो एक ही तरह का कॉन्ट्रैक्ट होता है, बट आरआईएल का ऑप्शन मार्केट में डील करने जाओ तो 600 तरह के कॉन्ट्रैक्ट बन सकते हैं। देखो मैं आपको दिखाता हूं, अगर आप एक रियल लाइफ सिचुएशन हम यहां लें, हम आते हैं NSE-India.com पे, कि बीएससी में डेरिवेटिव का उतना वॉल्यूम नहीं है। यहाँ पे हम कोई सा भी एक शेयर सर्च कर लेते हैं, चलो आरआईएल ही ले लेते हैं। रिलायंस इंडस्ट्रीज लिमिटेड, ठीक है। तो ये आरआईएल का आज फ्राइडे है, मार्केट तो चल रहा है अभी। तो आरआईएल का जो शेयर प्राइस है वो 1943 रुपीज चल रहा है एज ऑफ नाउ। अब आप देखें कि मैंने करंट शेयर प्राइस को तो छोड़ा 1943 को, यहां मेरे पास एक डेरिवेटिव्स का भी ऑप्शन है, मेरी स्क्रीन पे देखिए डेरिवेटिव्स। मैंने डेरिवेटिव्स पे क्लिक कर दिया। अब डेरिवेटिव्स में ना कई तरह के डेरिवेटिव कॉन्ट्रैक्ट मेरे पास अवेलेबल है, स्टॉक ऑप्शन, स्टॉक फ्यूचर्स। क्या करना चाहता हूं मैं इसमें ऑप्शन चेन पे क्लिक कर देता हूं। अब आप देखो ब्यूटी, जब मैं ऑप्शन चेन पे क्लिक कर रहा हूं, इस समय पर अगर आप देखोगे यहां, तो कैन यू सी कि कितने ढेर सारी स्ट्राइक प्राइजेस आरआईएल में अवेलेबल है। 1943 इज द करंट मार्केट प्राइस। ये देखो आप, ये 1940 ये करंट मार्केट प्राइस के पास का ही भाव है। सॉरी, जस्ट अ मिनट। ये देखिए आप, आरआईएल का जो ऑप्शन अवेलेबल है वो 1360 रुपीज की स्ट्राइक प्राइस पे भी अवेलेबल है, 1360, 1380, 1400, सो ऑन, 1940 ये जो अभी करंट प्राइस है वो, एंड देन 1360 से लेके 2680, इतना लंबा स्पेक्ट्रम अवेलेबल है। इनमें से कोई भी स्ट्राइक प्राइस आप चूज कर सकते हैं, और ये सिर्फ कौन से वाले हैं मालूम है? एक्सपायरी डेट है इसकी 27 मई 2021, दैट्स इट। और ये सारी स्ट्राइक प्राइसेस जो हैं, ये देखिए, ये इतनी ढेर सारी स्ट्राइक प्राइसेस आपके पास में अवेलेबल। और फिर अब इसमें कॉल ऑप्शन एंड पुट ऑप्शन, अगर आप बोलो कि आई वांट टू बाय आरआईएल एट 1360 रुपीज ओनली ऑन 27 मई 2021, तो उसकी जो प्रीमियम है ना, वो तकरीबन 700 रुपए के आसपास प्रीमियम आपको देनी पड़ जाएगी। 785, लुक हियर दिस वन। बट इफ यू चूज कि नहीं उतना सस्ता नहीं खरीदना है, जो अभी भाव चल रहा है 1900, उसके आसपास ही खरीद लूंगा मैं, तो मुझे बहुत सस्ता नहीं खरीदना। आई वॉन्ट टू बाय आरआईएल ऑन 27 मई 2021 at 1940 rupees, then the premium is 55.70/56. If you want to sell the option, you can immediately sell it at 55.70. If you want to buy the option, you can immediately buy it 56 rupees. Pay 56 rupees premium. Here the premium itself was 700 rupees because you are asking very favorable strike price. Here you are asking a reasonable strike price, so a reasonable premium of 56 rupees is to be paid. If you ask a very unfavorable strike price, नहीं मैं तो 2700 रुपए में RIL खरीदूंगा, then you'll have to pay a very low premium, 90 पैसा only. So this is the spectrum. ये सिर्फ 1 month का है. ऐसा पूरे इतने सारे कॉल ऑप्शन आपको 2 months के लिए भी मिलेंगे और यही सब आपको 3 months के लिए भी. Look, आप अगर ध्यान से एक चीज देखेंगे तो you will find yellow and white background. This yellow background are in the money options and white background are out of the money options. What is in the money option? अगर आप एक favorable strike price choose कर लेते हैं कि मैं सस्ता खरीदूंगा, that is in the money option, premium ज्यादा होती है. What is out of the money option? अगर आप unfavorable strike price choose कर लेते हैं यहाँ पे तो प्रीमियम कम लगता है. पुट ऑप्शन में उल्टा हो जाता है. ये देखिए, ये look here, this is put option. This right hand side area entirely is put option. तो अगर आप बोलते हैं कि I'm ready to sell it 1360 rupees, I'm ready to sell it 1360 rupees. In that case, you know what happens? $1,360, I am ready to sell. If you say, in that case, you will have to pay a very low premium of 25 paisa because it is out of the money option. सस्ता बेच रहे हैं आप और महंगा बेचने की बात करेंगे तो in the money option हो जाएगा वो. और ये देखिए उसकी प्रीमियम 2680. So premium itself will be 819 rupees. So yes, you can choose the strike price, but accordingly you'll have to pay premium. If you ask for a favorable strike price, it is in the money, pay high premium. If you ask for unfavorable strike price, it is out of the money and you'll have to pay lower premium. Now, one is call option, other one is put option. Again, options are of two types. European option, which can be exercised only at expiry after 3 months, after 1 month. American option that can be exercised on any day till expiry. तो अभी जैसे गोल्ड वाला एग्जांपल हम लें कि I said कि I will buy gold at 47,000 after 3 months, and if it is European option, then I can exercise my option only at the end of 3rd month. अभी बीच में कहीं बहुत ज्यादा भाव बढ़ जाए, प्राइस फेवरेबल हो जाए, तो भी मैं एक्सरसाइज नहीं कर सकता अपना ऑप्शन. स्क्वायर ऑफ कर सकता हूं कॉन्ट्रैक्ट, किसी और पार्टी के साथ में सेल कर दिया, आपके साथ बाय करा, वो स्क्वायर ऑफ है. बट आप ही के साथ में डील करने के लिए मुझे उसको करना पड़ेगा एक्सरसाइज. यूरोपियन कैन बी एक्सरसाइज ओनली एट एक्सपायरी. अमेरिकन ऑप्शन कैन बी एक्सरसाइज्ड ऑन एनी डे. तो यू मस्ट थिंक कि अमेरिकन ऑप्शन होल्डर के लिए ज्यादा फेवरेबल है. जिस दिन जाके भाव बहुत बढ़ गया, उसी दिन उसने बोला कि आई वांट टू एक्सरसाइज इट टुडे सो दैट वो डिफरेंस अमाउंट ज्यादा कमा सके. Right? So this is the example. On 1st April, I become the call holder. Strike price is 1200. Suppose expiry date is 25th June. Suppose underlying is RIL. Suppose premium paid is 50 rupees. Okay? तो एक तो होता है एक्सरसाइज और एक होता है स्क्वायर ऑफ. एक्सरसाइज मैं आप ही के साथ करता हूं क्योंकि कॉन्ट्रैक्ट आपके साथ किया था. स्क्वायर ऑफ कैसे होता है कि नाउ आई डोंट वेट फ्रॉम 1st April till 25th June. I don't wait from 1st April till 25th June. Rather than suppose on 15th April itself, I want to get rid of this contract. So here I became call holder by paying premium of 50 rupees. On 15th April, if I want to cut this contract, I can become call writer at the same strike price of 1200 for the same expiry date of 25th June for the same underlying of RIH share. But here I will not pay premium, here I will receive premium. Suppose the premium is reduced, then I'll sustain a loss. I paid premium 50, now I received premium 15, there is a loss of 35. On the other hand, if I paid premium 50 and here premiums become 65, so I'll have a profit of 15 rupees. तो कहने के लिए यूरोपियन ऑप्शन केवल एक्सपायरी पर ही एक्सरसाइज होते हैं, बीच में नहीं होते हैं, बट बीच में उनको स्क्वायर ऑफ तो किया ही जा सकता है. I hope you understood difference between exercise and square off. You know, if I exercise the contract, not only my position will be closed, but also your position will be closed. But if I square off, I won't deal with you again. I'll go to some other party and take a reverse position. So my position will be squared off and your position will still continue. That is square off. Practically, there is no difference between American and European. American can be exercised on any day. European can be exercised only at expiry, say after 3 months, but can be squared off on any day. Feel free to ask me if you have any doubts, sir. Nishan ji, Shivani ji, Vipul ji, Divya ji, Lokesh ji, Ankit ji, Sachin ji. I hope everything is clear. Fantastic. Okay, so let's quickly explore what is in the money, at the money, and out of the money. Suppose current market price of the stock is 500 rupees. And I say this is the strike price table. This is strike price. In this table, I'm writing strike price. So for a 500 rupees share, if I choose 400 rupees to be the strike price, it is in the money option because I'm asking a favorable price and I'll have to pay high premium. If I say I want to have 500 rupees as the strike price, it is at the money option. And the premium will be moderate. If I choose strike price to be 600, it is out of the money and premium will be low. For put option, if I say I want to sell it 600, it is favorable strike price and this is in the money put option. 500 is at the money put option and 400 is out of the money put option. Okay, so now you understand very well what are the concepts of options. So now you're in a position to make valuation of options. Let's do it. See, following terminologies I'll be using. VC is value of call option, that is option premium. So strike, in case of futures, you choose the future price. In case in case of futures, future price is determined by market forces. In case of option, strike price you choose. So what is market determined? Premium. You choose the strike price and then the option premium is determined by market forces. VC is value of call option, that is call premium. VP is value of put option, that is put premium. DS is current value of the stock, आज का बाजार भाव. E is the strike price or the exercise price. So value of option is actually dependent on 6 factors: current market price, strike price, time to expiry, risk-free rate of interest, volatility of the share price, and dividend to be paid by the company. Value of an option is dependent on 6 factors. It's complicated to make valuation of options because options value is dependent on 6 factors. Now, what are those 6 factors? These are 6 factors. Now, how the price is dependent on these factors? We'll study that. See, considering all 6 factors at a time will make it very complicated to make valuation of option. So let's learn it step by step. Learning step number 1. Let's do valuation of option at expiry. So we don't want to make valuation of option on 7th May. अभी इस एग्जांपल में क्या था कि ऑप्शन इज एक्सपायरिंग ऑन 27th May, but we are making valuation on 7th May. Obviously this is how it happens, but suppose I am making valuation of option at expiry on 27th May 2021 at 3:30 p.m. market closing time. So say I am making valuation of option just 1 second before it is expired. Okay, if I am making valuation of option at expiry, time to expiry will not be 3 months, it will be 0. If time is 0, interest rate becomes useless because interest is applied with respect to time. If time is 0, volatility is also useless because a share is volatile over a period of time. In next 1 second, volatility will not be there. And in next 1 second, company is not expected to pay dividend. If I take 3 months option, then there are chances that during these 3 months, company may pay dividend. In next 1 second, dividend is not going to be paid. So if I'm making valuation of option at expiry, only 2 factors remain relevant: current market price and strike price. And the formula looks like this. Value of call option is current market price minus strike price. So if current market price of the share is 950 rupees and I choose a strike price of current market price of the share is 1000 rupees and I choose a strike price of 950, then the answer is value of call option is 50. If I choose the strike price to be 1050, then the premium will be negative. But practically, premium can never be negative. Practically, premium can never be negative. So we always treat it as 0 if it becomes negative. Negative premium means holder won't pay premium, writer will pay premium. That never happens. Now, see the logic behind this formula. It's very logical. This is whatever you calculate is the ideal premium. See, this is obtained by calculation, not obtained from the market. Whatever you calculate is the ideal premium. Actual premium may differ. Suppose actual premium appears to be 30 rupees. Then there is an arbitrage opportunity. Do you know what is arbitrage? So there are 7 participants in this class. I'm asking you one question, simple. What is arbitrage? Yeah, Lokesh ji.
बेसिकली आर्बिट्रेज मींस कि भाई दो वैल्यू के बीच में एक डिफरेंस क्रिएट हो जाता है जिसको हम एज अ अपॉर्चुनिटी मतलब प्रॉफिट के टर्म्स में उसको हम इस्तेमाल कर सकते हैं.
बहुत बढ़िया, वेरी गुड. Any other person would like to say anything? So Lokesh ji was right. It is disequilibrium. तो आइडियली प्राइस होनी चाहिए ऑप्शन की 50 और एक्चुअली मिली 30. So you compare ideal and actual, and If it is lower than the ideal, it is underpriced. If it is higher than the ideal, it is overpriced. If anything is underpriced, you must buy it. If anything is overpriced, you must sell it. If it is available for 30, it is underpriced, go and buy it. तुरंत खरीद लो ऑप्शन 30 रुपए देके, अगले 1 सेकंड में ऑप्शन एक्सपायर हो जाएगा, आप ऑप्शन एक्सरसाइज करके 50 रुपए ले लेना. You have a right to buy at 950 ना, and share is worth 1000. 1 सेकंड में ऑप्शन एक्सपायर होगा, exercise it and recover 50 by paying premium of 30 and make a clear profit of 20 rupees in 1 second per share. तो अगर मार्केट में प्राइस 30 रुपीज होगा तो ढेर सारे लोग इमीडिएटली खरीदने आ जाएंगे और डिमांड बढ़ेगी ऑप्शन की, और डिमांड बढ़ने से उसकी प्राइस बढ़ के 50 रुपीज पे आ जाएगी. ऑन द अदर हैंड, अगर मार्केट प्राइस, प्रीमियम की मार्केट प्राइस 60 रुपीज हो जाती है तो राइटर्स तैयार हो जाएंगे, ऑप्शन बेचने को लोग धड़ाधड़ तैयार हो जाएंगे. 60 रुपए लेके इमीडिएट ऑप्शन बेचो, 1 सेकंड बाद ऑप्शन एक्सपायर, सामने वाला आपका ऑप्शन एक्सरसाइज करके 50 रुपए ले जाएगा, पर प्रीमियम तो आपने 60 रुपए कमाया था, 10 रुपए सीधा प्रॉफिट. If this happens, everybody will be ready to sell, or selling pressure में premium will reduce from 60 to 50. Moral of the story: this formula is logical. If the market disobeys this formula, बाजार मना कर दे कि we disregard, ये क्या फॉर्मूला है, हम हमारे हिसाब से प्रीमियम चलाएं, then there will be disequilibrium and you can make arbitrage and make profit immediately. आर्बिट्रेजर एक बहुत ही भला आदमी होता है, वो ना केवल सिर्फ अपना प्रॉफिट करता है बल्कि मार्केट में जो डिसइक्विलिब्रियम आ गया है उसको वो इक्विलिब्रियम में कन्वर्ट भी कर देता है. ओके, the same thing goes with put option also. In case of call option, what did you do? You did VS minus E. But in case of put option ना, वो तो भाव गिरने पे एक्सरसाइज होता है, VS जितना गिरेगा उतना फायदा आएगा. So in case of put option, it is E minus VS. Flip. This is call option. If this is call option, this is put option. Call and put. E minus VS. तो स्ट्राइक प्राइस 1000 रुपीज के शेयर के लिए आपने चूज कर ली 950. I'm sorry. ये मुझे ऐसा लिखना था कि 1000. अच्छा ठीक है, ये तो नेगेटिव होगा तो 0 हो जाएगा. आई जस्ट वांटेड टू से, और 1060 स्ट्राइक प्राइस चूज करूंगा तो ज्यादा मैं बेच पाऊंगा और 60 का मुझे प्रॉफिट होगा. जहां नेगेटिव होता है वहां 0 कर लूंगा. चलिए, लर्निंग स्टेप नंबर 2, वैल्यूएशन ऑफ ऑप्शन बिफोर एक्सपायरी. दिस टाइम वी आर वैल्यूइंग बिफोर एक्सपायरी, but we are ignoring volatility. We are valuing before expiry but ignoring volatility. So before expiry means current market price, strike price are relevant, time to expiry is relevant, risk-free rate is also relevant. Volatility is not relevant because I have assumed that there is no volatility. Dividend अभी हम मान रहे हैं कि 0 है, उसको हम बाद में देखेंगे. So valuation of option before expiry but ignoring volatility. मतलब आज अगर शेयर 1000 रुपीज का है तो 6 महीने बाद भी 1000 का ही रहेगा. In this case, there is a little change in formula. Here the formula was VS minus E. Look here, VS is already in present, current market price. E is to be used in future because it is the strike price, exercise price, which will be used on the expiry date. VS तो ऑलरेडी प्रेजेंट में है और E फ्यूचर में है, तो बस हमको E की प्रेजेंट वैल्यू निकालना है. Rather than saying VS minus E, I'll say VS minus present value of E. See this formula, adjust our. Compare two formulas. This is VS minus E. This one is VS minus present value of E. I need to calculate present value of strike price because that is in future. VS is already in present. So let's take the same example. 1000 rupees is the market price, 950 is the strike price. Suppose risk-free rate of interest is 10%. Suppose time to expiry is 0.5 years, 6 months, I mean. solve it and you'll get it equal to 95.24. अभी पहले आंसर 50 rupees था, and now this time the answer is 95.24, because option value has two components. One is intrinsic value and other one is time value. In this example, 50 rupees is intrinsic value. So what is intrinsic value? Intrinsic value is the amount by which an option is in the money. Intrinsic value is the amount by which an option is in the money. So 50 rupees is intrinsic value and balancing figure is time value. Time value of this option is 45.24. Okay, now let's take a situation that market disregards this formula. बाजार ने बोला why should we follow this formula, और मार्केट ने डिसरिगार्ड कर दिया फॉर्मूला को और बोला कि एक्चुअल वैल्यू ऑफ कॉल ऑप्शन 60 है. Now ideal value is 95, actual value is 60, so call option is undervalued. If the call option is undervalued, you must buy it. So today you must buy call option at a strike price of 950 by paying premium of 60 rupees. I should buy call option because it is undervalued. तो देखिए आर्बिट्रेज के बारे में मैं आपको एक इंपॉर्टेंट बात बताता हूं. जैसे इंदौर में गोल्ड का प्राइस 47,000 है, बॉम्बे में गोल्ड का प्राइस 50,000 है. तो I'll buy gold in Indore at 47,000 and I'll sell gold in Bombay at 50,000 and make profit. आर्बिट्रेज कभी भी ऐसा नहीं होगा इंदौर से भी ले लो, बॉम्बे से भी खरीद लो, इंदौर में भी बेच दो, बॉम्बे में बेच दो. No, that's not arbitrage. You buy at one place, you sell at other place, then only it is arbitrage. तो buy call मतलब you have right to buy share, so eventually you will buy the share. तो buy arbitrage नहीं होता है, sell arbitrage नहीं होता है. कॉल खरीद के एक्चुअली आपने शेयर खरीद लिया है. कब खरीदा है? अभी इंदौर और बॉम्बे नहीं है, अभी प्रेजेंट और फ्यूचर है, दो मार्केट है. Not one Indore, one Bombay, but one present, one future. So you have bought share in the future market, so you must sell share in the present market at 1,000 rupees. और अभी आपके हाथ में 940 आ जाएंगे, so don't keep that money idle. उस 940 rupees को आप क्या करो, इन्वेस्ट कर दो. Why to keep the money idle? उस 940 को क्या कर दो, इन्वेस्ट. Look, you bought the call because it is undervalued. 95 worth of thing is available for 60. Buying the call means buying the stock in future market. So in one market you are buying, so in this market you must sell. By selling the stock you got 1,000 rupees, so 940 rupees should be invested. Why to keep the money idle? Now after 6 months the price will still remain 1,000 rupees because we have assumed no volatility. The price will still remain 1,000 rupees. We have assumed no volatility. So you will exercise the option. You have the strike price of 950, market price of 1,000. Exercise the option and get 50. You sold this stock today at 1,000 rupees. You will buy it again. You sold it just for the purpose of doing arbitrage. So you'll buy it again and keep it in your stock. गोडाउन में से निकाल के आपने बेच तो दिया था आर्बिट्रेज करने के लिए, अब वापस से आप खरीद लेंगे इसको. And this invested money 940 rupees you will realize back, it will become 987. How come 987? See, it's very simple. 940 plus 5%. 940 plus 10% per annum was interest, so for 6 months it is 5%. 987. So अभी क्या होता है, किसी भी आर्बिट्रेज की ना 3 लक्षण होते हैं. There are 3 characteristics of an arbitrage. No investment. Look here, zero investment. No risk. In this case, there is no risk because you're going to make a profit of 37 rupees. Price is not going to fluctuate, hence there is no risk. And positive return. Yes, positive return of 37 rupees. No investment. Look here, no investment. No risk because you're not getting a loss. And positive return. Now I'll tell you one interesting thing. ये प्रॉफिट आपको 6 महीने के बाद होगा. If you calculate present value of this profit, if you calculate present value of this profit, it will be 35.24. And see, the option is actually undervalued by 35.24 itself. This is how you make a profit. And if you're able to make a profit by zero investment and zero risk, obviously you would like to do it. Everybody would like to do it. And if many people start this, everybody will be buying call today. If many people started buying call today, there will be buying pressure on call option. So from 60, it will rise to 65, 70, 75, 80, 85, 90, 95, 95.24. Once it reaches 95.24, this 37 rupees profit will become zero. So arbitrage will stop automatically. Moral of the story, this formula is perfect. If market disregard this formula, market will be in disequilibrium and there will be arbitrage opportunity and arbitrager will soon convert it into equilibrium. So this formula is perfect. Now learning step number 3. See, what we did is we ignored volatility, but the fact of life is volatility is always there. In first step, we considered 2 factors. In second step, we considered 4 factors. Now we will consider volatility also. But volatility is something very complicated. So I will not consider volatility fully. First, I will consider partial volatility. First, I will consider a little amount of volatility. So my learning step number 3 is called binomial pricing model. Valuation of option before expiry considering some volatility. What do you mean by some volatility? See, a share is priced today at 1,000 rupees. Tell me what can be its price after 6 months? Price can take any value after 6 months. Price can remain 1,000. It can become 1,000, 10,000, 20,000, 50. It can also reduce to 950, 900 level and so on. But we are assuming that there are only 2 possible prices of option at expiry. Only 2 probable prices. So current stock price is 1,000. So we are assuming that there can be only one upside price. After 6 months, it will go up to exact 1,100 or it will become exact 900. No third possibility we are exploring. Only 2 possible prices we are taking. Now that's wrong. Share can take infinite possible prices. But yeah, currently we are considering only 2 possible prices. So upside and downside. As we are considering only 2 prices, and it is named as binomial pricing model. Let's take a short break for 10-15 minutes because the next concept is going to be, very engaging. So let's have it at 2. This is 10:58. 11:13 a.m. I think will be a good time to restart. All right. Thank you. Okay, welcome back to the session. Our learning step number 3 for option valuation is the binomial pricing model. Here we are assuming partial volatility. We are assuming that there are only two probable prices, one on the upside and the other one on the downside. So 1,000 rupees share within 6 months can become either 1100 or 900. Nothing else is possible. Only two possibilities are there. How to make valuation in this case? Okay, one more thing, say strike price is in the money, 950 rupees for the call option. Now see, let's assume this is the European option, can be exercised only at expiry. After 6 months, if price appears to be 1100 rupees, while strike price is 950 rupees, so the option holder will receive 150 rupees. So just like you have upside value of stock, you also have upside value of the call option. Upside value of call option at expiry is 1100 minus 950, that is 150. If the price comes down to 900 rupees, you won't exercise the option and you'll be getting 0 rupees. So if upside and downside value of stock are 1100 and 900 respectively, upside and downside value of call option at expiry is 150 and 0. Now there are 3 steps to make valuation of call option. These are standard steps. You need to follow this. Step number 1, you need to calculate option delta. So option delta is a kind of hedge ratio. Option delta is a kind of hedge ratio. And there is a specific formula to calculate option delta. And the formula looks like this. You take upside value of call option minus downside value of call option in numerator, and upside value of call option minus downside value of call option in denominator. So that's 150 and 0, 1100 and 900. What does it mean? While the share price will fluctuate in the range of 200 rupees, option premium fluctuation range is just 150. You know one thing, that this is the strike price. Now share price may fluctuate above and below strike price. So this is the range of fluctuation of share price, up, down, up, down. But this is the range of option price fluctuation, up, not down, up, not down. This is option range, this is share range. Share fluctuation range is 200, option fluctuation range is 150 in this case. So option delta is 0.75. You know, what does it mean? Imagine a tarazu, you know, the weighing scale. Have you ever seen that tarazu in old times? You know, the sabzi wala people used to carry. On one side, they will put that weighing measure, tarazu bat, and other side they'll put the stuff, vegetable or anything else. So imagine a tarazu weighing scale. So on one side you put one share. So one share is 200 grams. On other side you put one option. One option is 150 grams. This is, so the weight of the share is 200, weight of the option is 150. This is stock, this is option, so it will be like this. To balance it, to hedge it perfectly, hedging is eliminating risk, balancing it. To hedge it perfectly, if you are keeping one option on this side, you need to put only 0.75 share on the other side. This is the hedged portfolio. In your portfolio, don't take one share and one option. Take 0.75 shares and one option, then only you'll be able to make a perfectly hedged portfolio. What is a hedged portfolio? This is a bunch of investment which will give you same result irrespective of volatility of the share price. If I simply buy share, then I'll face the volatility. If I simply buy option, then I'll face the volatility. But if I buy a combination of share and option in opposite direction, buy share and sell option, sell share and buy option, then they will cancel out each other's volatility. So step 2 is to calculate value of perfectly hedged portfolio. Value of a perfectly hedged portfolio. There's a shortcut to calculate that value. Later I'll justify this also, don't worry. Maturity value of a perfectly hedged portfolio is downside value of stock multiplied by delta. Your downside value of stock is 900, delta is 0.75. So value of your perfectly hedged portfolio is 675. Derivation behind this formula I'll tell you later. Step 3 is to calculate value of call option. So, the formula is like this. If you look at this formula carefully, you will find that this is somewhat similar to the previous formula. Our first formula was VC is equal to VS minus E. So instead of VS, now this is VS into delta. And instead of E for strike price, this is M for maturity value. And in the last formula also, we calculated present value of E. Here we are calculating present value of M. M includes E also. 1,000 rupees is current market price. 0.75 is the delta. Maturity value is 675. Divided by 10% is the interest rate. Number of years are 0.5. So that way it is 107.14 auction value. Now try to recall in the same example when we made valuation at expiry, the value was 50 rupees. Then we made valuation before expiry, ignoring volatility. The value was 95.24. And now before expiry, considering partial volatility, the value is further higher, 107.14. Now this is the ideal value. If the actual value is not equal to this value, then there will be arbitrage. I think I'll create one arbitrage table quickly for you. Let's borrow this table from here. Now suppose, what if the actual value of call option is say, whatever, let's say 80 rupees. If actual value of call option is 80 rupees, the call option is undervalued because it should be worth 107. While it is available just for 80. Just a minute. Sorry. So let me just create it afresh. Actual value of call option is just 80. So call option is undervalued and you must buy it today by paying 80 rupees, 80.00. But as I told you, buying the option actually means that you'll be buying the share in the future market. So in today's market, you must sell it. So by selling it, you'll get 1,000 rupees, right? So you have got 920 rupees of surplus. It is advisable to make investment of this 920 rupees of surplus. But I will like to make an amendment to it. I'm sorry. If I buy one call, I'll sell 0.75 stock. So that's the strategy. Delta is the hedge ratio. For one option, you don't need one share. You just need 0.75 shares. So here you will sell 7 0.75 share and you'll get 750 rupees. So here it is 750 minus 80, which is equal to 670. Hence I will invest 670 rupees. Now after 6 months, there are two probable prices. Either it will rise to 1100 rupees or it will fall to 900 rupees, right? If the price rises to 1100 rupees, definitely I'll exercise my call option and receive 150 rupees. Now, if the price is 1100 rupees, I'll buy my share back. 1100 into 0.75. So I will be paying 825 rupees to buy this share again. I sold it now, so I'll buy it again. My investment of 670 rupees plus 5% must have become 703.50, right? So look here now, 703.5 plus 150 minus 825 becomes 28.5. Here it is 0. My profit is 28.5 if price rises. But what if price falls? See, if the price is rising, I'm making profit. Maybe when price falls, I'll sustain a loss. Let's check it. If price falls, I'll not exercise the option because it will be out of the money in that case. But 900 into 0.75, I'll buy back the share at 675.00. My investment will again mature at 703.50 because majority of investment at risk-free rate is not dependent on share price. So now 675 and 703.5. Beautiful thing is, see the beauty. This is called arbitrage. Number one, there is no investment. Look here. 0. There is no investment. Number two, there is no risk. Look here. Even if price rises or falls, my portfolio value remains same, 28.5. This is called perfectly hedged portfolio. This is called perfectly hedged portfolio. In fact, if I consider only this part, this is the perfectly hedged portfolio. Even if the price falls, I'm getting 675 and 0. That is 675. If the price rises, I'm getting this 825 and 150. Again, the net of these two figures is 675. This is 675. This is also 675. And that's why I was saying that the value of perfectly hedged portfolio is 675. And the formula was downside value of stock multiplied by delta. So this is downside value of stock 900 multiplied by delta 0.75. Hence it is 675. So that's the shortcut to calculate value of perfectly hedged portfolio. There are three characteristics of arbitrage. Number one is there is no investment. So look here, this is 0 investment. Number two, there is no risk. Price rises or falls, you're getting the same figure. That is, there is no risk. Number three, there is positive return. If I calculate present value of this positive return, present value of 28.5 will be 27.14. And see the beauty, 107.14 is the ideal price, 80 rupees is the actual price. So the option is undervalued by 27.14, and that's why you're getting a profit of 27.14. Moral of the story, market if disregards this formula, there will be disequilibrium. People will do arbitrage and eventually the price will reach equilibrium, which is suggested by this formula. Moral of the story, this is a perfect formula. This is called binomial pricing model. So this is the step presentation of binomial pricing model. Some people also make a diagrammatic presentation of binomial pricing model where that is also called as lattice model. That is, they make two branches, a binomial tree they prepare. Upside value of the call option is 150, downside value of the call option is 0, and then they calculate average with some specific weights. That is also the way. People also make an alternative way of calculating this. The alternative way of solving this question is, like, upside value of call option is 150 and downside value of call option is 0. You take weighted average with spatial weights. So that is another way. I'll give you alternative solution also to this question, which is more popular way. Here you will kind of calculate weight to be assigned. And that weight to be assigned will be like this. I'll name that weight as P. P is equal to kind of I'll just keep the life simple. Otherwise, you will get confused. 1 plus RT minus D divided by U minus D. So 1 plus RT is 1.05. D is, what is D? I'll tell you. D and U. So upside value of the upside factor is 1100 has become the upside price. So 1100 by 1000 is 1.10. And downside factor is kind of 900 divided by 1000. So that is 0.90. So upside factor is 1.10 and downside factor is 0.90. So this actually becomes 1.15 divided by 0.20. I'm sorry, it's not 1.15. 0.15 divided by 1. Am I right? 50. Yeah. Now, luckily, see, this is just a coincidence that delta was 0.75 and P is also 0.75, but that is not always the case. So once you get P, you can calculate 1 minus P. So that's very simple. 1 minus 0.075. So 0.25 it is. Now I'll tell you how to calculate option value. So first I'll calculate average. See, there are two prices of option. Upside value is 150 and the weight is 0.75. Downside value is 0 and the weight is 0.25. So that becomes 150 into 0.75. So average is 112. I'm sorry, it's 0.25. 0.25. 112.5. Then I calculate present value. So 112.5 divided by 1.05. That is again 107.14. So that's the alternative solution. Instead of 3 steps, one can also do it like this. And for this, people make a kind of diagram also like this. They make a diagram like this also, that the upside value of the stock, if the price rises, the upside value of call option will become 150. Just a minute. Okay, just give me one moment. I'll create it by drawing tool. This seems to be a difficult way. So people call it like this, that the current price of the stock is 1,000 rupees and it can go up to 1100 or it can come down to 900. If it goes up to 1100, it will become 150 option. Here it will become 0. And if you calculate weight, this is 0.75, P is 0.75 and 1 minus P is 0.25. When you roll it back and calculate present value, that present value becomes 107.1. So this is another way, but anyways, you can memorize one of the two ways. This is how you calculate value of option using binomial pricing model. Okay. And now here we go with the last one. That is the Black-Scholes option pricing model. Now we will consider full volatility. Why should we consider that there are only two probable prices? We should consider that there are n probable prices. If there are n probable prices, then this Nobel winning formula is there, which is based on the concept of integral calculus. Yes, you heard it right. It is based on the concept of integral calculus. And now here, the only thing you can do is to memorize steps. I cannot explain it to you logically. The only thing that can be done is to memorize the step. First of all, you need to calculate D1. You must be thinking that this is just theory. Do we ever need to do such things in real life? Yes, definitely you need to do this. Black-Scholes is a frequently used formula for options. But where do we value options practically? Look, it's very simple. Practically, to make valuation of ESOPs, employee stock option scheme, you need option valuation. To make valuation of optionally convertible debentures, option is there. To make valuation of optionally convertible preference share, options are there. To make valuation of warrants which are issued to the top management so that they perform better, warrant is nothing but right to buy share. To make valuation of debentures with warrants, again, option valuation is required. So yes, there are ways: binomial pricing model, Black-Scholes model. One can also use Monte Carlo simulation, but Black-Scholes is the widely used model. So step number one is to calculate D1, which is natural logarithm of VS upon E. VS is the current market price, E is the strike price, ln stands for natural log. Then plus R plus half of sigma square into T divided by sigma under root T. See, VS is current market price of the share, E is strike price, R is the risk-free rate of interest, T is the number of years till expiry. This already, you know already, this thing. Now what is sigma? Sigma is volatility of the share return. So how volatile return is the share providing? Sigma is standard deviation. You must have studied it somewhere. Mean, standard deviation, correlation, regression. Sigma is standard deviation of share return. How volatile is the share's return? That is actually sigma. So this is sigma. Natural log is just something, log table you must have heard somewhere. This is natural log. For a normal log, base number is 10. For a natural log, base number is E, 2.71828. Once you calculate D1, you can calculate D2. D1, D2 formulas are exactly same with one difference. Here you have the plus sign and here you have the minus sign. So the shortcut for D2 is D1 minus sigma under root T. Once you calculate D1 and D2, then you calculate ND1 and ND2. How do you calculate ND1? You look at the Z table. So yes, there is a concept named as Z table. Look at the Z table value of D1 to arrive at ND1, and then you look at the Z table value of D2 to arrive at ND2. And then finally, you can use this formula. Yes, this formula. VC is equal to Vs into ND1 minus E into ND2 divided by E to the power RT. That's the Black-Scholes formula. I doubt that in examination they will expect you to write down this formula, but definitely this formula can help you. All this discussion can help you to fill up this table, and they always ask at least one MCQ based on this table. Now let's talk about this table. So how does the current market price affect value of call option? Look at this formula and tell me if Vs rises. Look at the highlighted formula on screen. Look at the selected formula. If Vs increases, what happens to VC?
VC will also increase, sir.
Exactly. So for expensive, if the strike price remains same and share का भाव बढ़ता जाए, तो call option भी महंगा होता जाएगा. If one increases, other one also increases. So there is a direct relationship between the market price and value of call option. Higher the market price, higher the value of call option, keeping all other things constant. What happens to VC if E increases strike price? You choose a higher strike price. If E increases, VC reduces. You know, अगर आपने बहुत ज़्यादा strike price choose कर ली तो वो in the money की जगह out of the money हो जाएगा. और अभी हमने NSE की साइड पे भी देखा कि if it is out of the money, the premium is on the lower side. Higher the strike price, lower the option premium. Look here, 1360 is the strike price, option premium is 785. And if you choose 1940 as the strike price, option premium is just 55 rupees, right? Just a minute. Look here, 1360, 787 is the premium. And 1940, only 55 rupees is the premium. Higher the strike price, lower the call option premium. So there is inverse relationship. Now look at this formula, okay? This one, just copy and paste it for you here. Look at this formula and tell me if the time to expiry rises in this formula, what should happen to VC? You are on mute. I can't hear you. Okay, anyways. If the time to expiry rises, then present value of strike price will reduce. If this figure reduces, VC increases. So with increase in time, call option value also increases. You know, if I simply become a call option writer, I'm called naked call writer. That is, I have not taken any protection and I have just become the writer. But becoming a naked call writer is very risky. You can have unlimited loss. So people usually don't become naked call writer, they become covered call writer. So on one hand, they become the call writer, and on the other hand, they buy and keep the share in their demat account. So even if the price rises and the call option becomes loss making, the rise in share price will be profit making and you will be compensated. So to become a covered call writer, you need to borrow money and buy stock and keep it with you. So if longer the time, higher will be the interest burden call writer will have to bear to protect itself. That is logic, and this is formula. In either case, it's direct relationship. Again, if the risk-free rate of interest rises, just like if the time rises, VC rises. So if the risk-free rate rises, VC also rises. you must ask a question to yourself: why the risk-free rate of interest? Why not risk-bearing rate? See, we were doing arbitrage. This all these formulas were proved through arbitrage, right? And what is arbitrage? It's a risk-free process. That's why you take your risk-free rate of return. So if risk-free rate rises, becoming a call writer will become expensive and you will charge more premium. Direct relationship. Volatility. So see, let's go by logic now, not by formula. I asked you to become a call writer for a share which can fluctuate between 900 rupees and 1100 rupees. It is expected that it will not come down below 900. It will not go up above 1100. It will fluctuate between 900 and 1100. Share A. Share B is volatile between 500 rupees and 1500 rupees. This kind of volatility is there. So if I ask you to become writer of share B rather than writer of share A, you will take a more risky position. And to compensate yourself, you demand a higher risk premium. You know why higher volatility means higher loss for the writer? 900 to 1100. So writer will never make a profit if price comes down, but he'll sustain a loss if price goes up. So 1000 to 1100 if it becomes, writer will suffer a loss of 100. 1000 to 900 if it becomes, nothing happens to writer. 1000 to 1500 if it becomes, writer suffers a loss of 500. 1000 to 500 if it becomes, writer doesn't suffer a loss. In case of future valuation, we don't consider volatility because it gives you upside as well as downside. But in case of option, holder gets advantage of upside only and no disadvantage of downside. That's why higher the volatility, higher the expected loss to the writer. That's why he'll charge a higher premium. That's why there is a direct relationship between the call option value and volatility. Now, dividend, how do you consider dividend in this entire model? Just do one thing. Say you are taking 6 months call option and company is expected to pay dividend at the end of 4th month. So you calculate present value of that dividend, which is receivable after 4 years, and deduct it from VS, current value of stock. This way you will get a modified VS, new VS. Now use this new VS in any of the formulas. The simple thing is, if a company will pay dividend, then its VS will definitely reduce. If VS reduces, then VC reduces. So higher dividend means lower VC. Inverse relation. They'll ask you at least one question. If the time to expiry happens, what happens to the value of call option? Rises, falls, remains same, is not dependent, kind of. You know, for put option, reverse thing will happen. If this has a direct relationship, here we will have inverse relation. If this is inverse, for put option, this will be direct. Because instead of VS minus E, in case of put option, it becomes E minus VS. And that's why these two direct will also become inverse. So put option is just reverse of the call option. Okay. You just memorize call option, put option, just do reverse. You need not to memorize it separately. Then as far as volatility is concerned, both put and call option has direct relationship. You know, because if you are the option writer, whether it is call option or put option, if the share is more volatile, you may have to suffer more loss. Hence, you will ask for more premium. This is the only item where both call and put behave in the same manner. volatility. Otherwise, for all other inputs, put option behaves in a reverse manner as compared to call option. Let me tell you one more thing. If you, number one, this Black-Scholes option pricing model, this can be used only for valuation of European options. The formula is designed in such a manner that this model, Black-Scholes model, can be used only to make valuation of European options. It is not suitable for American options, number one. Number two, Black-Scholes model ignores dividend payment. So later, Black-Scholes and Merton, M-E-R-T-O-N, later Black-Scholes and Merton valuation model was created, which considers dividend also. So they may ask you 1 mark MCQ that the formula which considers dividend also for valuation of European option is Black-Scholes model or Black-Scholes and Merton option pricing model, or is it Modigliani and Miller approach, or some other name, Gordon's growth model? Then you will say it is the Black-Scholes and Merton pricing model. So this is one more fact you need to consider. Okay. Just try to absorb this. And ask me if you have any question. Meanwhile, I'll quickly tell you the options which are used in assumptions which are used in Black-Scholes and Merton pricing model. The Black-Scholes model is a European option. It cannot make valuation of American option or some other exotic options like Bermuda option. It assumes that dividend is not paid during the period of option. It assumes that markets are efficient. You know, there are theories of market efficiency, weak form, semi-strong form, strong form of market efficiency. Market are efficient means it is difficult to predict the share price. There are no transaction costs in buying and selling of options. This is another assumption of Black-Scholes model. The risk-free rate and volatility of the underlying are known and they are constant. The risk-free rate is simply the Government of India bond rate. If the option is for 6 months, look at the 6 months treasury bill rate, that will become the risk-free rate. The risk-free rate and volatility. In real life, you know, forecasting future volatility of the stock is very difficult. So rather than using the historical volatility, people sometimes use implied volatility also. So they are assuming, okay, risk-free rate is known, that's a fine assumption, but volatility is known is a not so practical assumption. And the returns on the underlying are normally distributed. This is also one of the assumptions of Black-Scholes model. Try to recall, I said to calculate ND1 and ND2 and Black-Scholes, you need to use Z table. So Z table is for standard normal probability distribution. So here we are assuming that the returns are not skewed. Returns are normally distributed. just please. Okay. All right. So that's it. Tell me if you have any doubts on the same.
प्रैक्टिकली जो रिस्क फ्री इंटरेस्ट रेट है वो कैसे लिया जाएगा?
ट्रेजरी बिल, जैसे आपको 3 महीने का ऑप्शन का वैल्यूएशन करना है, तो जो भी ट्रेजरी बिल की प्रिवेलिंग यील्ड है 3 महीने वाले ट्रेजरी बिल की, बस उसी को रिस्क फ्री रेट ले लेंगे.
ठीक है.
Okay. Any other doubt to anybody? Looks like there are no more doubts. ठीक है जी, thank you, bye bye.
Thank you sir, bye bye.
Most welcome जी. Okay, bye. Take care.
Thank you.